Close your eyes for a moment, take a deep breath. Now, imagine waking up tomorrow morning. The sun is streaming through your window. You reach over to your nightstand and grab your phone and do what millions of us do first thing. You check your bank account. You tap on your banking app, wait for it to load, enter your password, and you see a single number, 0. Not because you spent it all on a wild shopping spree, not because someone hacked your account in the middle of the night, but because the entire system, the banks, the government, the institutions we trust decided that those numbers were never real money to begin with. Crazy, right? Impossible? Something that could never happen in a modern, developed nation? Well, maybe not as impossible as you think. Throughout history, this exact scenario has played out more times than most people realize. In Cyprus in 2013, people woke up to find that the government had seized a portion of their bank deposits overnight. In Argentina in 2001, bank accounts were frozen, and people couldn't access their own money for months. In Greece, during the 2015 debt crisis, ATM withdrawals were limited to just €60 per day. And here's the thing that most people never stop to consider. The money sitting in your bank account, the number you see on that screen, it's more like a shadow. A promise, a number floating in a digital void. Today, we're going to pull back the curtain on the financial system. We're going to explore why your bank balance isn't actually money in the way you probably think it is. And most importantly, we're going to discuss what that really means for you, your savings, and your financial future. This isn't conspiracy theory territory. This is simply how the banking system works. And once you understand it, you'll never look at your money the same way again. To understand why your bank balance isn't really money, we first need to go back in time, way back. Thousands of years ago, before banks existed, before governments printed currency, humans had a problem. How do you trade with someone who has something you want, but doesn't want anything you have? If you're a farmer with wheat and you need shoes, but the shoemaker doesn't want wheat, you're stuck. This is called the double coincidence of wants, and it was a massive barrier to trade. So civilizations started using intermediary items, things that everyone agreed had value. In ancient Mesopotamia, they used barley. In parts of Africa and Asia, people used cowrie shells. The Aztecs used cacao beans. Some Pacific Island cultures used massive stone discs that were too heavy to even move. But eventually, humanity settled on something more practical, metal, specifically precious metals like gold and silver. Gold was perfect. It was rare enough to be valuable, but common enough to be useful. It didn't rust or corrode. It was divisible. You could melt it down and split it up, and it was recognizable. A gold coin looked like a gold coin whether you were in Rome, Persia, or China. For centuries, this system worked beautifully. Money was tangible. You could hold it, weigh it, bite it to make sure it was real. When you had 10 gold coins, you had 10 gold coins. There was no ambiguity, no abstraction. But then, something changed. People got tired of carrying heavy coins around. Gold was valuable, yes, but it was also inconvenient and dangerous. Bandits would rob travelers, coins would get lost at sea. Carrying large amounts of wealth was physically exhausting. So a new idea emerged. What if someone trustworthy could hold your gold for you? Enter the banks. The word bank actually comes from the Italian word banco, meaning bench. In medieval Italy, moneylenders would set up benches in town squares, exchanging currencies and holding deposits for merchants and travelers. The concept spread throughout Europe. Goldsmiths in London became early bankers, storing gold in their secure vaults. When you deposited your gold, they'd give you a paper receipt, a promise that you could return anytime and collect your precious metal. These receipts became incredibly convenient. Instead of hauling around bags of gold, you could just hand someone a piece of paper. The paper itself had no intrinsic value, but it represented something real, actual gold sitting in an actual vault. Simple, secure, straightforward, right? Well, here's where things start to get interesting, and where the foundation of our modern banking system begins. The goldsmiths noticed something peculiar. Day after day, they'd see people depositing gold and receiving receipts. But not everyone came back at the same time to withdraw their gold. In fact, on any given day, only a small percentage of depositors actually wanted their physical gold back. And so, a very tempting idea crept into their minds. What if we lend out some of this gold to other people? The original depositors won't know. As long as we keep enough gold on hand for the few people who do come to withdraw, we can make money by charging interest on loans. This, my friends, is the birth of *** fractional, reserve banking ***. The goldsmith might have 100 customers, each depositing one gold coin. That's 100 gold coins in the vault. But if only 10 people typically want their gold on any given week, the goldsmith could lend out 90 coins and still meet demand. The problem, now there are essentially 190 gold coins in circulation, the original 100 represented by receipts, plus the 90 that were lent out and are being spent in the economy. The goldsmith created money not by mining gold, not by minting coins, but simply by lending out deposits and trusting that not everyone would ask for their gold back at the same time. This was revolutionary. This was also, in a sense, the first great illusion of modern finance. Fast forward a few centuries. Over time, those paper receipts, the promises of gold, became more trusted than the gold itself. People started trading the papers directly. Why bother going to the vault? The paper was easier to carry, easier to divide, easier to use. Governments saw an opportunity. Instead of letting private banks issue their own notes, why not have a central authority create standardized paper currency? This would be more uniform, more trustworthy, and crucially, more controllable. And so, central banks emerged. The Bank of England was founded in 1694. The Federal Reserve was created in 1913. These institutions became the ultimate issuers of currency. But here's the key shift. At first, paper currency was still backed by gold. You could theoretically take your dollars or pounds to the central bank and exchange them for physical gold. This was called the gold standard. Then, in 1971, President Richard Nixon made an announcement that changed everything. The United States would no longer convert dollars to gold at a fixed rate. Other countries followed. The gold standard was dead. From that moment on, money was no longer backed by anything physical. It was backed by trust. Trust in the government, trust in the economy, trust in the collective belief that these pieces of paper, and later, these digital entries had value. This is what economists call *** fiat currency ***. Fiat is Latin for let it be done. Money has value because the government says it has value and because we all agree to believe it. Now, let's bring this into the modern era. By the late 20th century, computers had transformed the banking system. Paper ledgers became electronic databases. Physical currency became increasingly obsolete. Today, when you check your bank balance, you're not looking at a representation of gold coins in a vault. You're not even looking at a representation of paper bills in a safe. You're looking at a number in a database, an entry on a computer server somewhere, probably backed up in multiple data centers around the world. According to the Bank of England, approximately *** 97% of money in modern economies exists only as digital entries ***. Physical, cash, the bills in your wallet, the coins in your pocket, represents just 3% of all money. Let that sink in. Almost all of the wealth in our economy is nothing more than numbers on screens, electrons in computer chips, entries in databases. Now let's go deeper into how money is actually created in our modern system. This is where things get really fascinating and maybe a little unsettling. Most people assume that when you deposit money in a bank, the bank holds onto that money for you, like a safety deposit box. Your money sits there waiting for you to withdraw it, but that's not how it works, not even close. Let's walk through a scenario. Imagine you deposit $1,000 into Bank A. The bank is required to keep a fraction of that deposit as reserves, let's say 10% for this example. That means Bank A keeps $100 in reserve and is free to lend out $900. Now, let's say Bank A lends that $900 to someone who wants to buy a used car. The car seller receives $900 and deposits it into Bank B. Bank B now has $900 in deposits. It keeps 10%. That's $90 in reserve and lends out $810 to someone else. That borrower spends the money, it gets deposited into Bank C, and the cycle continues. Bank C lends out $729. Bank D lends out $656, and so on. By the time this cycle has repeated several times, your original $1,000 deposit has transformed into roughly $10,000 of money circulating in the economy. This is called the ** money multiplier effect **. Banks don't just store money, they multiply it. They create new money every time they issue a loan. Where does this new money come from? It comes from nowhere and everywhere simultaneously. It's created through the act of lending itself. When a bank approves your mortgage, it doesn't go into a vault and take out stacks of cash to give you. It simply types a number into a computer, and suddenly that money exists. This isn't some fringe economic theory. This is mainstream banking knowledge. The Bank of England published a paper in 2014 explicitly stating that commercial banks create money when they make loans. The money doesn't come from someone else's deposits, it's created fresh as a bookkeeping entry. Think about that for a moment. The money for your car loan, your mortgage, your credit card. It didn't exist until the bank decided to lend it to you. It was created, quite literally, out of thin air. This is why economists distinguish between two types of money, ***, base money, ***, and ***, broad money, ***. Base money is the physical currency plus the reserves that commercial banks hold at the central bank. This is the real money, if we can even call it that, the foundation of the system. Broad money is everything that functions as money in the economy, including all those digital bank deposits. Broad money is much, much larger than base money because of the money multiplier effect. Your bank balance is part of broad money. It's money that was created through lending, through the banking system's ability to multiply deposits. At the top of this pyramid sit the central banks, the Federal Reserve in the United States, the European Central Bank, the Bank of England, the Bank of Japan. These institutions don't create money in the way commercial banks do. They're even more powerful. They control the base money, the foundation upon which everything else is built. When you hear that the Fed injected $100 billion into the economy, what does that actually mean? It doesn't mean trucks loaded with cash driving around the country, distributing bills to citizens. In most cases, it means the Federal Reserve bought assets, usually government bonds, from banks and paid for them by crediting those banks' reserve accounts. In other words, they typed bigger numbers into a computer. This is called ***, quantitative easing ***, and it became a household term after the 2008 financial crisis. Central banks created trillions of dollars, euros, and pounds this way, not by printing physical bills, but by creating digital reserves. During the COVID-19 pandemic, this went into overdrive. Federal Reserve's balance sheet, a measure of how much money it has created, went from about $4 trillion in early 2020 to nearly $9 trillion by 2022. The European Central Bank expanded its balance sheet by similar proportions. Where did all this money come from? It was created, conjured into existence through the power that central banks have to simply make it so. This might sound alarming, and in some ways it should be, but it's also important to understand that this system has enabled incredible economic growth. The ability to create money flexibly has allowed economies to respond to crises, fund development, and expand in ways that a rigid gold standard never could. The question isn't whether this system is good or bad. It's whether we understand it, and most people don't. So, what happens when this intricate web of promises, digital entries, and fractional reserves starts to unravel? We don't have to imagine, we have historical examples. In 2008, the global financial system came closer to collapse than most people realize. Banks had been lending money for mortgages at unprecedented rates. These mortgages were packaged into complex financial products and sold around the world. Everyone assumed housing prices would keep rising. Everyone assumed the borrowers would keep paying. They were wrong. When housing prices started falling and borrowers started defaulting, suddenly those complex financial products became worthless. But here's the thing, banks had used those products as assets, as the basis for even more lending. The whole system was interconnected. Bank A owed money to Bank B, which owed money to Bank C, which owed money back to Bank A. When the trust evaporated, when banks stopped believing that other banks could pay their debts, the whole system seized up. Lehman Brothers, one of the largest investment banks in the world, collapsed overnight. Other major institutions were on the brink. ATM nearly stopped working. The payment systems that allow businesses to pay employees, that allow stores to accept credit cards, that allow the entire economy to function, they almost ground to a halt. This wasn't about physical money running out. There was plenty of paper currency in circulation. The crisis was about trust, trust in the digital promises, trust in the numbers on screens, trust in the web of obligations that held the financial system together. Millions of people lost their homes, their jobs, their retirement savings, not because cash disappeared, but because the promises behind those digital numbers failed. And this brings us to a crucial point. Bank runs, remember the trampoline analogy, your deposit is a person jumping on. The bank lets multiple people jump, but the trampoline only has limited physical support. If too many people try to withdraw their money at once, if everyone panics and rushes to the bank, the system collapses. We saw this in 2023 with Silicon Valley Bank. In a matter of days, depositors withdrew tens of billions of dollars. The bank couldn't meet the demand, it failed, other regional banks followed, the Federal Deposit Insurance Corporation, stepped in to guarantee deposits, preventing a broader panic. But it was a stark reminder that the system is more fragile than we like to believe, so why do we act like these digital numbers are real money? Why does the system work at all? Because of something incredibly powerful and incredibly fragile, collective belief. Money is, at its core, social technology ***. It works because we all agree that it works. When you hand someone a $20 bill, they accept it not because of the paper it's printed on, that paper is worth fractions of a cent. They accept it because they believe that everyone else will also accept it. The same is true for your bank balance. You believe your $10 in savings is real because you trust that the bank will give it to you when you ask for it. The grocery store trusts it because they believe the bank will honor the transaction. The landlord trusts it. The government trusts it. It's a massive, interconnected web of belief, and it works until it doesn't. This is why confidence is so important in economics. This is why central bankers choose their words so carefully. This is why a single rumor about a bank's stability can cause a fatal run on deposits. Money is trust crystallized into numbers. The philosopher Yuval Noah Harari calls money the most successful story ever told. It's a collective fiction that allows strangers to cooperate on a massive scale. Without it, modern civilization, as we know it, would be impossible. But we should never forget that it is, in the end, a story. A powerful one, a useful one, but a story nonetheless. Understanding all of this naturally leads to a question: are there alternatives? This is where things like cryptocurrency enter the conversation. Bitcoin was created in 2009, in the immediate aftermath of the financial crisis, by a mysterious figure known as Satoshi Nakamoto. The idea was radical. What if we could have money that didn't rely on trust in banks or governments? Instead of trusting a central authority to manage the ledger, Bitcoin uses a decentralized network. Thousands of computers around the world maintain identical copies of every transaction ever made. To change the record, you'd have to hack the majority of these computers simultaneously, practically impossible. Instead of banks creating money through lending, Bitcoin has a fixed supply. Only 21 million Bitcoins will ever exist, hard, coded into the software. Cryptocurrency is not perfect. It's volatile, it's often used for speculation, the technology is complex and inaccessible to many. And some would argue that it has simply created new forms of the same problems, different kinds of trust, different kinds of risk. But it represents an attempt to solve the fundamental issue we've been discussing, the fact that traditional money is ultimately just trust in institutions that can fail. Beyond cryptocurrency, there are other considerations. Real estate has long been seen as a hard asset, as something physical that holds value. Gold, despite no longer backing our currency, remains popular as a store of value. Even art, collectibles, and other tangible goods serve as alternatives to purely digital wealth. The lesson isn't that you should abandon banks and put all your money into gold bars under your mattress. The lesson is that diversification matters. Understanding that digital money is a promise, not a thing, should inform how you think about your financial security. So let's return to where we started, your bank balance, that number on your phone screen. What is it really? It's not gold in a vault. It's not even paper in a safe. It's an entry in a database, a promise from your bank. A node in a vast network of promises multiplied through lending, ultimately backed by trust in the system. This doesn't mean your money has no value. It clearly does. You can buy groceries with it, pay rent, save for the future. The system works most of the time for most people, but value is fragile. It depends on trust. It depends on rules. It depends on invisible banking mechanics that most people never learn about. It can bend. It can break. It can expand or contract at the push of a button. The next time you glance at your bank balance, take a moment to really think about what you're seeing. Are you holding money or are you holding numbers? And more importantly, now that you understand this, what are you going to do about it? Educate yourself about how money works. Diversify your assets. Don't put all your trust in any single institution or system. And remember that the most valuable thing you have isn't the number in your account. It's the knowledge to navigate a world where money is more complex, more abstract, and more fragile than most people ever realize. Thank you for joining me on this journey. If this changed how you think about money, share it with someone else. Because in a world built on shared belief, understanding is power.